But ever since we got over the pandemic, Wall Street has punished the stocks that thrived during the worst days of COVID-19. The so-called pandemic names, they've been written off as returned to normalcy losers. Except for some temporary reprieves during the Delta and Omicron waves, they've either been dead money or totally toxic to your portfolio. And boy, have they weighed down on the NASDAQ. That is until today. Now, I'm not sure why. It could be because Elon Musk took a 9.2% stake in Twitter, a stock that performed admirably during the early days of the pandemic and has done awfully since. It could be because some major institutions simply decided that these beaten-down companies deserved a second look. I don't care. Let's take them one by one, starting with the poster child for the pandemic stocks, Peloton. Now, this stock traded up to $171, all right, early last year, before crashing down to $20 in one of the most ignominious swan dives I've ever seen. Too much inventory, possible cash crunch, poor management, the works. Even as the founder, John Foley, is a brilliant guy. Doesn't matter. With the crash and burn of the stationary bike stock, Peloton needed to bring in someone new. Unbelievably, they snared Barry McCarthy, the subscription mastermind who worked his magic at Netflix and Spotify. With McCarthy at the helm, I am bullish on Peloton. Even if this quarter's weak, I think it's worth owning as a long-term bargain, and today's 5.7% run makes sense to me. All right, how about the other pandemic poster child, Zoom Video? Eric Yuan. Paging Dr. Icarus. Zoom flew way too close to the sun. Right? Our Mr. Sun, tumbling from 588 to 94 in less than 18 months. So that is a move that's totally reminiscent of the dot-com era, isn't it? There's one difference, though. The dot-com obliterations weren't worth much because the businesses were never viable. Zoom, on the other hand, is extremely viable. It just got too expensive. Here's the real issue. It's still fairly expensive. It trades at 35 times earnings. Zoom simply must do something besides being a well-managed video conferencing company, or else it will wind up like the TV set companies of old. Think Admiral, RCA Victor. Too many competitors. There will be nothing special about a video phone suit. If they don't do something, if they remain as they are, then I say, count me out.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.